Alright, so I finally finished the Bollinger Band thing and I made it all variable, so you can just change the number and it'll show you different periods of time, so it's actually useful and now. But what it's trying to answer is the question of, say you're just watching the portfolio go up and down and up and down, and it starts to take a downturn like right here, and you're like, okay, it's not doing too hot. Is it going to continue? Is it going to keep going down? Like, is it going to be a big down? You don't know, right? And so to answer that question, we have the Bollinger Bands, and then we wanted to see what are the odds of like continuation from a historical standpoint. If it does continue, how big will the dip be on average for like each day count, and so on and so forth. So let's just get into it, because this is going to be annoying to explain and just go through because it's incredibly lengthy and I made it way more complicated than it has to be. But starting off, any of these orange cells are just inputs, so you can change those. Over here, the period SMA determines how big of a simple moving average you want it to be. It can be 20 day, 10 day, 100 day, doesn't matter. It'll all just shift. Everything will change when you hit that enter button. Then the standard deviations, you can have like a one standard deviation, two standard deviation, and it'll change it for both the upper and lower band accordingly. The max streak, don't touch it. It's part of calculations over here. But for this stuff, you can put any assets or securities information. All you need to do is have the date to the close and just copy paste it in here and it'll start switching all the numbers. Now, just to show you what this thing does, I'll just switch this from 10 days to 20. Bing. You see it takes out all the data over there and it creates 20 days standard or simple moving averages and it bases everything off that. There's different amounts of days below, different everything else. All the results change. But for this, we'll just leave it at 10 because I zoomed in the screen. Anyway, let's get into the calculations for how this thing works so that if you have to tinker with it or mess around with it, you know what to touch and what not to touch. Now, to make this thing fully variable to where you can just change this number and all this other stuff switches, I had to use the dark arts of indirect, and indirect can be a little bit finicky when you use certain things, so I highly recommend if you change things, don't add any rows before the F and G because F and G are listed in the indirect formulas as just F and G, and those don't change if you shift them over. So just don't move those over because you'll have an issue. I'll just give you an example. Just watch if I move this. It ruins everything. Um, so if you do have to add rows, I would add them after F and G. I think if you do that, nothing should change. Yeah, as you can see, no changes. Good. Anyways, so first calculation is returns. All of these are calculations. You don't need to touch them or anything. They work fine. But just to show you the calculations works, returns is just the percentage return from the previous day. So it is the current day and uh, subtracted from the previous day's close divided by the previous day's close. So it's just a percentage. So that would be uh, like 0.2%. And then for the simple moving average, I'll just start off with what's actually being used to calculate. So this function right here, this if statement, that is just to get it to where it does um, the period days. So like think of this as like just choosing how big of of the simple moving average it wants to be. If you want to look into that, it gets a little bit complicated, but it basically just says use it for the amount of rows and stuff like that. But what it's actually doing is just a average of the last 10 days. So it doesn't really have any data up until right here because there's not 10 days worth of data. And it just says what is the average of these, and I'll just show you the little test calculation. So average, then we just do that, and it comes out with 44.725. So that's what that does. Pretty simple. Um, then in order for that to work, like I said, it first determines whether or not there's enough data for it, which is determined by this right here, and then it does an average of F11, which is the day before, to an indirect of F, which is this this column right here, and the row number of whatever row we're currently in minus the standard or the simple moving average. So that would be 12 minus 10 because it's just using the numbers for this part. And so it would come out with 2. So it would be uh, F11 to F2 because that's what 12 minus 2 is, or 12 minus 10 is. And it's pretty much doing that same exact calculation anytime we use indirect for anything else. So I'm just going to leave that out every time you see indirect. For the standard deviations, it's doing the same exact thing. This determines whether or not it has enough room above it. So there is obviously not going to be any data when it's trying to do a 10-day standard deviation if there's only 2 days of data. For that, the standard deviation is just calculated by using standard deviation S of the indirect of the exact same function I was talking about, but rather than doing it off the close, we do it off the returns because that's what's useful. Upper bands are done just by having it first determines like the rest of them whether it has enough data to work with, and then it just does 1 plus the standard deviation times the standard deviation count. So we're using 2 standard deviations, and then it times that by the simple moving average to get the upper band. Same thing for the lower band, but instead of adding it, you subtract it off of the 1 so that it gets a lower band. Then over here, this just determines whether it's inside the band, outside the band, or just inside the band. For it, -1 means it's below the band, 0 means it's within the band, and 1 means it's above the band. Pretty simple. Once again, same function right there, but the if statements are just saying like if the close is greater than the upper band, then make it a 1. Same thing, but the lower band, and if it's negative, and it just keeps on going. After that, this is just a little side calculation. It just shows the return after the period. So basically, this is just doing um, row F, so right here the close, and then so it's row 13 plus the period. So it would be 13 plus 10, so we would get F23. So it's doing 23 minus F13 divided by F13. So this is just the return for 10 days after uh, each day. And then that changes depending on what your SMA is. If you have an SMA of 20, then it'll be a 20-day change, and so on and so forth. Of course, for that, we just have a positive negative, so this is just doing the same thing where it's saying is this positive or is it negative? So if this is greater than 0, then it's a 1. If it's less than 0, it's a -1. And if it's 0, then it's 0. That's just gauging whether it's a positive or negative return. It's nothing like crazy. Then days below the band. So back to the picture. When it goes below, you're trying to figure out, well, how many days is it going to keep going below the band? Just like on average, like we just want to kind of know some of that information, some of those descriptive statistics. And so we have to count the days it goes below the band. So this just does It just looks back to the inside the outside thing and it's like, okay, it is below the band right now. Like if that cell is a -1, then we just add 1 to the number in the cell before it. And then if this cell does not equal -1, in other words, if it's not outside the band, then it just makes it a 0 because we're only looking for the downside right now. And so you can see as it goes, it zeros all up until there's a -1, and then it adds 1 plus the cell before it, so that would be 1 plus 0, and so that cell is 1. But since this one has a 1 before it, it would just do 1 plus the cell before it, which is 2. And because it does that, it makes an actual streak. So when it went outside the band for this one, it went outside for 3 days. And then for the start slash end day counter, so this basically just says what's the starting date and what is the ending date. So it started on uh, the 17th and it ended on the 19th. The way it does this is it's basically just looking at the 3 cells, and so to see if it's a start date, it says is the cell before it, is that a 0? And is the cell after it greater than 0? Because if it's greater than 0, that means it started a streak. And then to see if it ends a streak, it basically says is the current cell that's to its left, is that one greater than 0? If so, then is the cell after it 0? Because that would indicate that the streak is ended because it's returned to the inside of the Bollinger Band. So that's just what it'll do for each time it goes outside the band. It'll do a 1 or a 2, and it does a 3 if it's just a little 1 day outside the band and it goes back inside the band. So if you see a 3, just know that's what it's doing. But you're probably never going to be looking at this data down here, so don't really worry about it. Then the return since leaving the Bollinger Band for each day outside the Bollinger Band. This is basically just saying, so for instance, uh, right here, it leaves the Bollinger Band, and you're like, okay, well, how has it returned since it's gone outside the Bollinger Band? In other words, if we see it go outside here, what is the percentage return from like this day back to up here? And it always goes back to the day it goes outside the Bollinger Band just to keep some continuity. And so the way it does that is indirect functions, and it basically says, okay, uh, it does the row F or the column F with row 13 minus O12. What's O12? O12 is the day counter, and since a streak starts, then it will be subtracting the streak as it goes along. So for instance, right here, it would be row 14 minus whatever the value is in O13. So it'd be 14 minus 1, which would be 13. So it would be F13. In other words, this row of cells. And because of the streak count, it will always just take it back to the first day. Then we have two different returns right here. One of the returns is the return for the last day below the band. In other words, when it terminates. So that would be giving the return for right here, right before it goes back inside the band. And then the other returns are for the returns of all the days that it's still inside, like every day that's not a returning part of the band. So that would be like these days where it's still outside the band, but it's not right about to go back inside. And then from that, we move over here to days below the band. So this will just show you the total amount of days, like streak-wise, that it's been outside the band. So in other words, when it goes outside the band like um, this time right here, it started on the 18th and it ended on the 24th. So that's like a 6-day period outside the band. But over here it might be like 3 days. So it's just the streak or how much time it's outside the band. And then that's determined by more indirect functions a little bit, and the also the max streak. So the max streak just tells you the maximum number that's in here. So that'll tell you the biggest streak. And then to the right of that, we have the occurrences. So this just shows how many times a 1 has appeared, because this function just shows it counts all the ones that are inside here. Now you're asking, why is that even remotely useful? Well, some of these are going to be days where it goes outside the Bollinger Band and goes straight back in. And other days are going to be days where it starts going outside the Bollinger Band and you don't know whether it's going to go back inside or stay outside. So you have to be able to discern between the terminating ones where they go back inside and the continuing ones where they go outside and then continue staying outside and just kind of float along. So the terminating occurrences are um, the kind of sneaky way that I did that is uh, the amount of occurrences for the day count minus the amount of occurrences for the next day account, right? And that makes sense because the the amount of occurrences for 1 days is going to be the maximum count of times it goes outside the Bollinger Band. So it's gone outside 379 times. Now, of those times, 177 of them continue to be 2 days outside the streak, right? And so you can say that because there's 177 times that it goes outside for 2 days, that you can just make the difference between those two to find out how many of them are terminating. So that's how we do that. And then for the continuing occurrences, we just do some quick math, which is the amount of occurrences minus the sum of the terminating occurrences. So that'll change as you go farther down. So it would be 379 minus the sum of all these to tell you how many times it continues. And then to the right of that is the percent of terminating occurrences outside the Bollinger Band. So this is pretty simple. It's just it's 202 divided by the total number of recurrences. So this would give you a percentage of how many times it's going to go outside the Bollinger Band and just go straight back up. So historically, with a 10-day moving average, that happened, or that accounted for half of all the occurrences of going beneath the Bollinger Band. And then what are the odds of it historically continuing? Like if it goes out for 1 day, is it going to continue? What are the odds for that? So for this one, it would be a 46% chance. Now, you'll notice on this one, these two, if you add them up, they just come up to be 100. That's because this is the first day. It changes as it goes along. So for the next one, it's a similar calculation, which is just the continuing occurrences divided by the total occurrences for that day period. And you can kind of notice there's some interesting points where it's a high historical percentage of occurrences that keep on going. In other words, it's almost like resistance or something like that. So for these points where it's low like that would be, you could almost kind of say that's like resistance for days outside the Bollinger Band. But if it reaches other days, like if it's 4 days outside the Bollinger Band for a 10-day moving average, then you can kind of say with a little bit of confidence that like odds are it'll probably continue. And then for all of this, we have some uh, descriptive statistics for it. So this is just a raw average of the returns from the days it's outside the Bollinger Band. And so that'll just be for the 1 day, for every time it's gone out the Bollinger Band for one single day, what is the raw average return from each one of those occurrences? And so it's negative 1.8. Um, 1 second. For the average of continuing, it does a similar thing, but it only does it for the days that are not terminating, right? Because we have this one over here that only does it for the days that are part of other streaks. And then for the average of terminating, it's just the average of these for each day count. Now, sometimes they'll be the same for all these. Uh, I don't think those are actually the same. I can move those percentages out a little bit. Uh, yeah, so you can see the terminating is slightly higher, but for other ones of these, you can see that they're pretty different. Like the average for the for instance, for the 7 day, right? The 7 days average of a continuing one is -6%, while a terminating one is -3.6%. Now that's kind of interesting because it means that if it's going to continue going down, it's going to be bigger, and so it's less likely to have started to rebound back up into the towards the simple moving average. That's kind of what happens a lot of time for a lot of these. When you get further down though, these it's not always the case because there's less and less occurrences. And so a lot of these lower numbers will be larger. And then we have the standard deviations for the raw, so that's just all of these. So standard deviation for all the 1 days, standard deviation for the continuing ones, so standard deviations of all those for 1 day, 2 days, and 3 days, depending on which one you're looking at. And then the standard deviation of the terminating ones for each day. So that's all these for like the 3 day, the 2 day, and all that. Then over here we have the Kelly criterion calculations, which these are very loose and I would probably change them, but they're still completely variable. But I would probably, this is just very basic. So this is just a Kelly criterion for if you were to invest with a, uh, like this is just if you were to invest for however many days is in the time period. So this is if you invest and then plan on taking your money out 10 days after you invest, what are the returns going to be like? So odds of it being positive are 60%, while odds of it being negative are 40%. For those, what are the odds or what's the average increase if it's a gain? It's 2%. What's the average loss? It's 3%, and then there's 17 days where it does nothing. But after that, we do a expected return, which is basically just it would be the odds of gains times the actual gains. So it'd be 60% of 2%, and then it'd be 60% of 2% plus the odds of loss times the average loss. So it'd be 40% times -3%. And then you get the expected return of 0.22, which is pretty small. But if you were to analyze that, which would just be that plus 1 to the power of, I guess, some, sure, then you would get something wild and outrageous and completely incorrect. But that's what an annualized return of just investing your money and then taking it out 10 days later would look like if it was always average. Now, that's pretty misleading because it's not, despite that being the expected return, it's not going to give out 0.22% each time. That's just kind of like over time what you'd expect to see as like you kind of break even sort of thing. So don't like take that with a massive grain of salt because that's completely unrealistic. But if you then want to see what the Kelly criterion of that is to see how much, if you wanted to strategically position an amount of money, then you would just divide the expected return by the gain and you get 10%, which is relatively low, and that's because the risk to reward ratio is not that strong. If you change the days, though, that'll always change, but this is a pretty unsophisticated way of investing. You're just kind of throwing money in for 10 days and then taking it out. Um, I haven't done any of the slope analysis to see because you can see for some of these, like if If you're outside the Bollinger Band, you can probably do some slope analysis and be like, okay, when a slope is greater than, I don't know, like -2 or whatever, then odds are it'll continue up until whatever day. But until I've done those calculations, it'll require a little bit more work to figure something out for an actual good strategy. But you can see as you change the days, all this changes over here. And let's just see what happens if we change it to 100 because I'm bored. Yeah, so it changes a lot of times the because the bigger um, SMA period that you choose will have bigger gains and stuff, then it'll have larger allocations because it's just a larger day count. And so you're risking stuff, but I don't know. Like I would take everything about that with a grain of salt. I'll switch that back to 10. If this causes your computer to lag, I'm not sorry. And then over here, this is the same exact thing that we did on the other page, but this one uses semi-deviations rather than just standard deviations, now, or whatever you call them. Simple standard deviations, I don't know. What's the purpose for that? Well, with normal Bollinger Bands, it assumes, or the way it calculates it is that variance is both positive and negative at the same respect. So each time you're looking at this, for instance, like right here, at this point, this line is equally distanced away from this line. Now, that doesn't mean that the variance is the same on both sides. Like right here, over this time period where it's just going up, there's going to be significantly less downside variance than there is upside variance. So should this line down here be proportionally as large, that's kind of something you see in the Bollinger Bands all the time, where despite the trend being very clear as to what's happening, like this is going down, it still has massive lines up here for really no reason. And so to kind of deal with that, we just took a semi-deviation approach. So the only difference is these two bars right here, the upper band just does a standard deviation of only the positive returns, whereas the lower band does a standard deviation of only the negative returns, which leads to interesting results because it shows volatility squeezes for the downside and the upside a bit more. I would probably find the downside ones a little bit more interesting than the upside ones because, for instance, if there's like a lot of grinding upwards, there'll be a period where it's like, okay, we haven't had a whole lot of large downsides, so you can kind of see like a negative volatility squeeze, which is interesting because it can help to kind of hedge your bets when the market's just going up and you're like, okay, I feel like it's probably going to go down pretty soon. So this will be able to help with that a bit. You can create an oscillator. I haven't done it yet because I don't really know the math behind it. I know it's just like the difference of the lower band minus the simple moving average divided by something else, but I haven't figured that out yet. Um, Now, because these two semi-deviations are different, pretty much in every case, there's going to be more occurrences of it going outside the Bollinger Band. And that makes sense because a lot of time it's like it's working with half a deck. So in this period right here, the other side of the Bollinger Band would be very close to the simple moving average, and so it becomes more responsive once it actually starts receiving more data. But up until like it has any big moves, it's going to be very small. So you can kind of anticipate when a market downturn might occur, but to what degree you'll have to figure that out on your own. That's pretty much it. If you have any questions, I don't know, send me an email, call me, shoot an email, put a comment in the video if you never want it to be answered, or anything like that. Yeah.